Welcome back to Trade with Conviction, your shortcut to making sense of the oil market. What another crazy week it has been, with 2026 already proving likely to surpass 2025 in terms of its unpredictability. And it looks like we'll be talking about geopolitics for a lot of the time. My name is Neil Crosby. I have Phil and Jorge on the pod with me today. Hi, guys. How are you?
Hi Phil. Hi Neil. Yeah, very good over here.
Yeah, also good. Thank you.
Good stuff. Why don't we kick off with? We've got quite a long script today with lots of things going on in the world, the rapidly changing world around us. I can kick us off. I kind of just want to riff back and forth with you guys a little bit. Obviously, the main headline has been Iran, and that has been the subject of, or the source of all the price action over the last few days. There is, I'm going to say there's relatively limited things that we can add to this topic. Obviously, we could go through it. We could dust off once again what might happen in case the Strait of Hormuz is closed, or what might happen in case regional infrastructure is attacked. But I think it's safe to say we just don't know what's going to happen. And the sort of latest headlines that we hear is that the US carrier group is heading into the region. Trump has tweeted, in effect, a de-escalatory tweet for now, but by no means is this thing over. And price action, to an extent, believes it is, but I don't think we can really believe that's true. Is that fair?
Yeah, it's difficult to know what to believe, right? There was a lot of theatre and a lot of kind of coordination in terms of public statements or leaked statements prior to the strikes last summer, right? So when you start to see headlines now of regional governments, Israel, having talked Trump down, it's difficult to know, what to believe, really.
Yeah. I mean, what seems certain is that it's a whole different ball game, right? It's not going to be as easy as, I'm going to send a carrier group into the region, I'm going to do a physical embargo, and in Venezuela that's a different kettle of fish, right? And the idea of getting a short, sharp intervention is not one that apparently comes easy. I mean, that's one that Trump is after, and the chances of that happening are quite low. So we'll see. There's still a chance it fizzles out. There's still a chance that the thing might escalate, if you like. And yeah, that's the status quo at the moment. And of course, cue also all the commentary that a lot of this comes as a distraction, in the same way that Greenland might be, from internal issues going on in the US as well. Plenty of headlines over the Fed, plenty of headlines about ICE. Very, very confusing time. What about, Jorge, you're going to talk about rather Venezuela, right? But do you have anything to add on the Iran situation, just with regards to NAFTA? Or do you want to save that for later?
Yeah, just a little comment maybe on NAFTA. I guess it's in another product as well, but the impact has been felt mainly through crude flat prices. So it has impacted cracks through crude movements, and it looks like at this level, like 63 Brents, we are back to where we were like 10 days ago before the conflict started. So yeah, I guess not many big headlines on the lighters market coming from Iran, more from Venezuela.
Yeah. Okay, we'll move on to that later. But just talking about Venezuela, that's also still moving the market, obviously filling the headlines with what's happening to Venezuelan crude. I note this morning an incredible headline that Nobel Prize winning Machado had given over her medal to Trump. Let's leave that hanging there. But
Yeah, no comment.
Anyway, collecting the FIFA prize and the Nobel Prize in the same year. No, the sort of latest on the crude side is that it does look like European trading houses are filling in the gap and going to market this crude globally. There's talk about it being marketed to India already, particular prices, and there has been a lot of comment on Venezuelan crude hitting the US Gulf Coast, but it looks likely to me that actually it's going to go to a variety of destinations, and it's quite unclear whether the Gulf Coast can even take that much Venezuelan crude in the first place. But it does bring us just to the sort of next question. It looks like more and more Venezuelan crude is going to be commandeered by the US government. I think that's a fair statement.
Yep.
And it brings up the question of what China does, because of now, essentially we've got risk to Venezuelan barrels, we've got risk to Iranian barrels, and Urals doesn't look like it's clearing all that well globally. So it's kind of up to China to kind of turn this around. And what does the Chinese purchasing look like going forward? They will purchase Russian HSSR. They don't really want to hit the spot market that much because the teapots are quite economically sensitive. So it's kind of a question of China now needs to clear up the Urals market. And that's one of the key unknowns for the next month, I would say.
Yeah, it feels like it's potentially even a significantly bearish risk, right? All the headlines are obviously bullish, or at least the expectation would be that they are bullish. But there's still that option, I suppose, that China just doesn't build as much this year. It seems, it's probably not the default scenario. It's probably unlikely, but it's out there. And then what happens? Then you get a lot of this sanctioned or difficult to place barrels piling up on water.
Yeah, and we've traditionally been of the kind of view that barrels always flow somehow. But I was trying to sift through some of the analysis yesterday. So now moving this on to India, right? Because one of our assumptions has been that India will return to its kind of 1.82 million barrel a day buying of Russian crude eventually. Yeah. But it hasn't happened so far. We're still sitting at 1 million barrels a day, 1.2. And the thing is that the heat is actually being turned up, right? So the EU has introduced draft proposal for member states to intervene in the shadow tanker fleet. The UK was involved in the Marinera story over the last week, that one tanker that was sailing in the North Atlantic that got essentially, whatever you want to call, impounded. The UK was involved in that. They weren't directly involved, but the UK is now coming up with a legal basis. Yeah, they're coming up with a legal basis to get more involved, and it seems like that's an important point in this whole story, right? We're increasingly getting to a situation where the shadow tanker fleet and the sanctioned tanker fleet is becoming like a military target, and that feels important. And just bringing that back to India as well, something that strikes me over the last few weeks have been more and more defense deals. The Indians are going to start building the French Rafale jet. They're going to start building German submarines. It seems like India is actually drifting towards the EU. And it makes me question, along with things like Reliance's statement that they're never going to import Urals again, really whether the Indians are going to pick back up all the Urals barrels that they had a few months ago. I'm starting to question that story, and maybe that's something we can pick up over the next week or two.
Yeah, sure. I think that the Reliance story in particular was, or is so far, a little bit surprising, right? We were under the impression that they would have this workaround if they wanted to keep diesel barrels flowing to Europe if they wanted to. So it does look like it's maybe more of a political decision.
Amid all these trade deals, and the Reliance statement was very vehement as well, right? It didn't do any qualifying language. It didn't say at this time we're looking elsewhere. It basically said we want to reject any media statement that accuses us essentially of picking up Urals. And that's quite an interesting statement, I found. Okay, so it's all go. Let's move on to the physical market, guys. Why don't we start off with the middle distillates? I think you're on the hook you're on the hook for this one, Phil. Where do we stand right now?
Yeah. So, let's start. Take a step back and think about where we are. Right, mid-Jan. Supply looks like it's been pretty decent for a while. We've had high runs, from at least through December now into January. Margins have been good. We've got a little bit of a return, it seems, in Russian barrels. Those Ukrainian attacks that were picking up through Q4. We're hearing less about those.
Yeah,
we've had a decently cold winter, but so far it seems at least supply potentially outweighing. At least that's what price would suggest. And we've had decent imports, right? So we're talking about good high runs, good margins in Europe, for example, but also high arrivals. We've seen for a while now or at least workable enough Gulf Coast arbs into Europe to keep that flow going. Those swing arbs out of the east, pointing west, and so it's probably unsurprising that the January gas oil expired only just positive, and Feb March is also it's currently trading in low single digits. So you've got that side of things. Although if we look at the cracks, those are still pretty. Those are comparatively much better supported, higher supported. What's the word? So you have to kind of wonder, I suppose, similar to gasoline, what has changed fundamentally this year, right? Versus last year, versus the year before. Why is it now that we should be justifying these relatively softer levels? And so I suppose probably bringing us forward to the conclusion a little bit. Are we primed for a risk to the upside from here, right? So what's the picture now? I suppose, as we mentioned, Gulf Coast ARB has been open for a while now. That's happened the last couple of winters as well. So nothing kind of particularly changing there necessarily.
Yeah.
But it means that despite that, right, we've still got PAD 3 stocks that are pretty high, PAD 1 stocks which are pretty low, and there's a bit of a discrepancy there in terms of low PAD 1 stocks and HOGO coming off despite that. And so if we're looking at kind of really what's the signal that the market is giving us right now, it's still trying to pull diesel into, or it's still able to keep these arbs open without gas oil spreads needing to be particularly high. And it's doing that, obviously, as I said, from the Gulf Coast, but it's also doing that from the west, right? From the east.
From the east, yeah.
So those swing arbs that we like to talk about, very much pointing west, both for diesel and for jet. And so we're going to see, at least, or I suppose the theory is that those barrels are going to be around to help cushion any kind of Q1 European maintenance that we have coming up. Things like Al Zour in the east, obviously returning. Dangote, we typically talk about it as a gasoline story, but obviously there will be a diesel impact as well to their supply as and when maintenance finishes there.
And a jet impact, of course, from Dangote.
And a jet impact, indeed. And I suppose, that being said, we had a little bit of a chat beforehand, we've probably come up with a slightly different conclusion, I think, you and I, Neil, on where we go from here.
So what's your conclusion, Phil? What do you think? What do you think? You think it's just more of the same?
I think
in terms of spreads.
I think we can probably get away with more of the same, in terms of spreads at least, right? As I said, cracks are still pretty supportive, right? Margins have come off, but they're not terrible. I think we have these open ARB signals coming in from the Gulf Coast. We have the swing arbs pointing west. Yes, demand is probably decent. It is cold, but I've not seen any kind of indication yet, at least, that we need to have a big rebound in spreads. Maybe I'm wrong. We don't have all of the information, of course, but from what I can see, I don't see I see the risk, but I could very well just see it plodding along at these kind of levels for a while.
Yeah. I mean, that's fair enough. It's I guess from my point of view, I try also occasionally to just take a wider view of it. And I think you've already mentioned, like, what's changed fundamentally. Have we grown available refining capacity? No. Is there a risk to supply? Yes, because supply actually went really well over the last few weeks. Europe supply, as far as I know, was strong. You had Pernis coming back. You had the US runs extremely high. You have US diesel supply in the Gulf Coast extremely strong just now. Also jet, by the way. You had return of some Middle Eastern refineries. So everything seemed to go well with high margins. And yet we didn't get any contango. And then I'm looking at things, infrequently we look at ARA stocks, and they are much lower than last year still. And it just feels like there will be a turning point. Russian supply presumably will be under threat again at some stage. We're about to get into maintenance. Apparently, I have heard US maintenance in the Gulf Coast will be quite strong this year. Seasonally, supply is about to dip anyway. I guess I'm just landing on the point where like everything's gone right in supply, and yet we didn't get any contango. Now the risk to supply is rising, and I feel like it's kind of like the setup on gasoline, where we're structurally tighter. Winter for gasoline is obviously a weak period, but there's just always this risk of a huge rally that basically comes out of nowhere because the market overreacts. And I feel like that's also how diesel trades, generally speaking, at the moment. It's a bit more like Bitcoin than anything else.
Yeah, it's fair. It's fair. I mean, already this morning, if we're looking at kind of the cash diffs, we're starting to see an uptick in the Med, for example. And as you said, it did only take kind of one or two little stories of refinery hiccups, not quite being able to run full utilization, some cold spec issues as well, and all of a sudden you get cash diffs that are rising, and that will eventually feed through into paper pricing as well, I suppose. Yeah, the one thing that obviously we don't have here at the moment, but to keep an eye on potentially, would be the demand impact. I mean, we assume demand is decent because it's cold, but I don't know what the structural impact of we do have structurally declining diesel demand in Europe, right? That's just what I'm going to cling on to now if I want to kind of counter the story of a potential rally. But you're right, the risk is certainly to the upside from here. I can agree on that.
Yeah, we'll get Jody data on Monday. I think the next release is on Monday, so next week we can decode the Jody data in terms of demand. My impression was that gas oil demand in Europe wasn't as bad as everybody expected, and the last couple of data points were rather bad for the US. But we'll come back to that next week. We'll get James on the pod now, pose him a few demand questions. All right, thanks very much, Phil. Why don't we go on to the light distillates? We welcome you back, Jorge, to talk about NAFTA. First time in a few weeks, I think, to talk about NAFTA. What's going on? It's mostly geopolitics, I take it.
Yeah. I think we haven't done an update this year yet on the podcast. I think the last one was last podcast of 2025. But I think we have three big topics. One of them more relevant than the others. But first of all, we have already talked about it. But the Iranian situation is impacting NAFTA market through a very volatile cracks in Europe and in Asia. I think that has been the biggest movement. If you look at time spreads, if you look at the physical market, the market has been mainly quiet since the beginning of the year. But we've seen a very big volatility in cracks. We are at the levels where we started the year right now. So in line with Brent movements, I think it's a lot about speculation. So nothing major on the physical market has materialized yet that could impact NAFTA market. Then the Venezuela story is different. We have wrote specifically about it, but the main dynamic there is that the more crude that Venezuela is able to produce and to export, the more NAFTA will be demanded to be used as diluent, because Orinoco crude is too heavy, so you need to use either condensate or NAFTA to make it lighter. So we were expecting a rising demand for this topic. We have already seen the first.
Just to stop you there, though, right? It's just, sorry to interrupt you mid flow.
Yeah.
But it's even if Venezuela's supply doesn't grow, which is basically the base case for the next few months, it's also just a switch effect, right? Because it has been Russia origin; those are sanctioned barrels, and now we're moving to the legit NAFTA market. Isn't that also what's happening?
Yeah, exactly. But especially if you compare it with the second half of last year, if you look at the historical, Venezuela has always relied on U.S. Gulf Coast NAFTA to be used as diluent. But during the second half of last year, especially Q4, it was more and more relying on Russian NAFTA.
Yeah.
Obviously, that is out of the equation right now. So it's a completely switch between Q4 last year and Q1 next year. So you are right on that point. And we have seen the first confirmation of a cargo from Beetle from US Gulf Coast into Venezuela, and we will expect this flow to keep increasing. Then the question is how much Venezuela will be able to rise its crude supply. So I'm sure you talk about that in the latest podcast. But maybe, yeah, in the medium term, we could see some upside from zero point 0.8, zero point 0.9 to 1.2, 1.3. And then in the long term, there is a stronger potential up to 3 million barrels per day, maybe the historical highs. So yeah, we were expecting more demand from Venezuela to for products from US Gulf Coast, and it has been felt in US Gulf Coast cash diffs for naphtha. We have seen an upside since for the last week or 10 days in light naphtha cash diffs for light sour and light sweet, and we will expect this dynamic to tighten a little bit the physical Western naphtha market.
Yeah, and has that already materially impacted the sort of traditional arbs that we look at? Obviously, we're not looking at an arb into Venezuela, but has that impacted where the Gulf Coast naphtha volumes are pointing versus
Not at
before?
the moment, not at the moment, I'd say, because yeah, Europe is too weak to attract cargoes from US Gulf Coast at the moment, and the main thing that is flowing into Asia is heavy naphtha.
Yeah,
So we have it haven't materialized on us change in the cash diff, but we could see potentially US Gulf Coast product being too expensive to be shipped to Europe if the demand
yeah,
from Venezuela is strong enough.
yeah. And then we're talking about a reshuffle, right? Because you have a bit more of tightness in the west. You have more Russian naphtha moving east, presumably,
Yeah,
and then that makes a slightly different puts a slightly different spin on what arb is needed in the legitimate market from the west to the east, right?
yeah, exactly. So the product that Russia was sending into Venezuela has to find a house. Well, probably in the east, but there are also some outlets in the west, mainly in East Med, that could be the house for these cargoes.
Mm-hmm.
Yeah,
East Med. I love the sort of politically correct East. It's the East Med.
yeah. Well, we have seen it as one of the main buyers for Russian naphtha in the west. So if the level has decreased, but it could rise again. Now there is more supply available. Yep, and with that, that's the biggest story. Venezuelan story is the big one in the west, and then we can move to the east. We have Iran there, but we have a strong story coming from the petrochemical industry. We have two different things. First one, we keep hearing about more crackers that are delaying ramping up. The last example is in Taiwan, is Formosa 1. So this is a dynamic that is being in the market for the end of 2025, and we keep seeing it during 2026. The margins for petchems are very weak in the east, and this can be a medium-term dynamic that can impact the demand for naphtha and well for naphtha and for LPG as well. But it can be a strong impact. That would be a medium long term story, I would say, for Q2 onwards. And then we have another headline coming from China. It's still uncertain because we don't have an official announcement, but China is expected to go with a new tax policy that is impacting NAFTA local trading. So there is already a tax that impacts these local sales, and they want to increase it by 200, 250 yuan per metric ton. And right now there are a lot of ways to escape paying this tax, and they want to make every ton pay for this. So this can have a
Mm.
huge impact, as I have said before. There is a lot of uncertainty, but basically it makes more expensive for Chinese blenders and Chinese petrochemical crackers to rely on local naphtha production. So it can, yeah, either harm the economics for blenders and petchems if they eat the whole tax, or it can impact the market through a different way. That is, make 4-inch product more attractive into the region. That is linked to the import quotas. They have remained the same for the first release of 2026 than what they were in 2025. But yeah, let's see. Maybe we could see if the tax materialize, we could see the quotas rising and more imports going into China. In another way, and I'm going to finish with this, is that it could also impact through higher demand of LPG or ethane to run the steam crackers, the ones that can switch between feedstocks. they can see better competitiveness against an NAFTA that is fully that is paying the taxes for the trade locally.
If I may, Jorge, just very quickly, for my kind of more simple brain, we talked, I suppose, as you said, last year about these record high east west and how that was probably not going to last. I can see it's come off over the last week or so. Is that probably going to? It sounds like overall we should probably expect that to keep coming off, or is it done enough now?
I think in the medium term, more likely that it will come off a little bit. I remember we did a podcast when it was over 40. I don't know if at close to 45 levels, and what we said is that it will remain strong, but it will be very hard to see those levels. So right now, it has come off $10 per metric ton from the maximal values, but it remains close to historical seasonal highs for January and February. So I think my idea keeps on that direction. We will have to see if Russia NAFTA for Venezuela finds a place in the east. But yeah, I would expect lower levels. Also, it's hard to see coming back to the historical average of plus 15.
Good stuff. Right. Why don't we put Phil's simple brain, in his own words, to work on the gasoline market? I'm just using your words, mate. What's happening on gasoline very quickly?
Yeah, just a short one. It's actually been a pretty volatile week this week. Not something that we necessarily saw coming, but last week when we talked about how kind of EVO had found a floor, it had opened up a lot of outlets. In doing so, obviously, it put a lot of pressure on the Asian complex. And the result was we've seen Sing 92 sliding into a decent contango now, and the east-west widening out to really cut off those east of Suez outlets for EBOB, or for European exporters, sorry. On top of that, the WAF buying seems to have been relatively short-lived. I think any possible shortfalls in the Nigerian balance for, let's say, end of Jan, early Feb, looks like there's confidence there that's been covered now. So that support has eroded, and it means that we've essentially then put the pressure back onto the European complex, and the EVOB contango widened out again in order to find a home for that kind of prompt supply. What was a little bit interesting, and yesterday especially, was that the price action was EBOB sold off and RBOB rallied. So we had a decent strengthening in the TA ARB, and that has also then pushed all of those LATAM ARBs definitively back to Europe, helped obviously by TC14 still being kind of stubbornly strong, TC2 not necessarily. I don't honestly have an explanation as to why RBOB would have rallied yesterday. The inventories in Pad 1 seem to have been building at a decent tick until recently, at least in the latest data. So something for me to go and investigate, I think. In the east, the Sing 92 MOP J spread has narrowed quite a bit. So that obviously should have been hurting blending econs in Singapore, but the movements on the east west in particular have overridden that, or have outweighed it. Sorry. So those kind of the outlets that we talked about that had pressured Singapore. So lack of Australian ARBs, lack of Coast Mexico, or even kind of other Pacific outlets, or the East and the South African outlets for the AG. Those are all pointing back to East of Suez outlets now. So East-West has done enough to kind of remove that pressure of Western barrels moving east. And so here we're going back to pricing storage, right? We know that there is still expectations for a pretty tight gasoline market when we get into the next maintenance round. So I think that the next maintenance cycle is going to be very interesting. The kind of blending and storing summer spec from February looks like it's just about workable at the moment, but just about workable if you have kind of decent storage econs. It looks like it's on the border. So it's not we're not pricing everybody to do this yet. So I think there is still a risk that we might not quite be building enough unless this contango can last a bit now.
Does that, just from my simple brain, is that a sort of signal that can kind of become the main driver of EBOB spreads at a certain point of the year? You know, if the market decides, okay, the storage econs don't look good enough, we've not built much for summer, I'm going to kind of bid up the deferred part of the curve so I can, you know, basically start to create these economics. And in the end, yeah, for the prompt, that means it prices down. Is that sort of something that can hold true for a few weeks if everything else is quiet?
100%. Yeah. And obviously it often coincides with, narratives building up to IE week as we get that in mid-Feb. So it is this time of year where you start to kind of have those conversations essentially. What's your balance like for Q2? What's your balance like?
Okay.
Are we building enough? If not, I'm going to start buying April. I'm going to start buying May.
Yeah. And again, with gasoline, I'm under the impression not much has changed about the fundamentals, right? You have good, in contrast to diesel, you have good demand growth in Europe. There's a structural shift going on. You've had refineries closing. You've got Dangote with a very checkered history, presumably not going to run, although it'll be a Jekyll and Hyde market when the headlines start to flash around. But in essence, what's changed from last year? Have we suddenly come up with lots of new supply? It doesn't seem like it.
Not in the West, at least, no.
Yeah. And actually in the East, it feels like, just as it is with diesel, in the East, it feels like if you had to take a guess at where Chinese runs go in the next couple of quarters, you would not necessarily guess that they go up. In fact, the risk is maybe to the downside because we have a teapot sector that may struggle for feedstock or to optimize its feedstock. So it could be that the Chinese exports of oil products are not exactly super hot over the next couple of weeks.
Yeah, no, 100%. I think that's certainly the prevailing narrative for now. And as you said, it feels reasonable if you just think about it on a structural level.
All right. Thank you very much, Phil. And Phil and Jorge, I'm going to ask for one trade idea at the end. So get those teed up and I'll take us through a bit of crude. My plan was just to explain what's happened and then to sort of flesh out by region what the physical picture looks like. So I think we can all see there was a massive paper rally that translated into a rally in the physical in the North Sea. I'm absolutely not surprised that this rally happened. It's clear why. It probably was made worse by the fact that there was relatively short positioning at the start of the year. I guess where things start to get more interesting is just how long can this really be sustained? And my thinking is that the market will have to revert to short positioning, will have to revert to a more bearish posture every time the headlines calm down, because in theory, the balances are still very long. And you can actually see some of this turning up in the US. I was just sort of recapping the US data. Crude and core products in the last 10 data points of the weekly data released are building at 1 million barrels per day. And that compares to 500,000 barrels per day in the prior 3 years for the same time of year. So something is happening in the US. And that's just the US. It feels like there is length, but we're in this Jekyll and Hyde market, right, with geopolitics. So I guess where it becomes interesting is at what point do you start to short and, looking for entry points when the market is again very positioned very shortly because there is too much supply in theory, but then the geopolitics comes back into it. And two other things, the EFS widened massively. That makes the RB cons to the east much harder. And actually TI for quite a few days looked very, very expensive in the east. And the TI Brent spread also blew out. That was a combination of Brent, but also probably a bit of the market trying to digest the notion that there's a lot more Venezuelan crude heading to the Gulf Coast. And therefore, the need for it basically lengthens the Cushing balance in a way. So that's what happened. I think both of these things end up reverting unless war breaks out. So I'm expecting the EFS to look a bit different in a week or two. Same for TI Brent. And I think the situation can possibly flip around a little bit. So the physical premiums in the North Sea are fairly decent. The DFL has been bid up. Some of the spot premiums are up, particularly in the North Sea, less so in WAF as far as I can tell. CPC has tightened up because, of course, the one actual big outage has come from Kazakhstan. because the SPM is struggling to get back. That should look different next month. As far as I know, February should see a bit of a normalization. There were also outages in Johann Castberg for 3 weeks. I think there's also a situation in Libya. It looks like weather might have impacted Libyan exports. So I'd say the tightness is in Europe specifically, but it should all come back. And the other factor is it feels like Dubai should be the next to be slightly bid up. Firstly, because it looks cheap everywhere. The whole sort of spot AG crude market looks cheap as a result of EFS, of course, but also the spot premiums in the AG are very low still, the exception being Murban. I can go into that in a minute.
Mm-hmm.
It looks like China might need to, at the margin, rely on a bit more spot crude. I'm not saying that's the main solution for them, but it looks like, some sanctioned crude has been taken away from China. They'll try and get more term crude. That's obviously happening with Aramco volumes. But at the margin, it looks like the outlook for Middle Eastern crude actually looks quite good. And it looks like OPEC exports are generally might have the tendency to drop a bit. And so I think this thing can flip around, right? Eventually Brent corrects. Eventually Dubai can be bid up. I'm just noting the Murban FOB premiums, like they've actually gone on quite a rally the last few days. And part of the reasoning there might be because it's the interest in it, in using it as a blend, in a blend with heavy crudes to approximate Urals, is supposedly rising. And that's also where I hark back to the India outlook. If they are really not going to pick up much more Urals or potentially even drop more Urals, where do they turn to? And they turn to a bit more LATAM, but they also turn to the short haul stuff, which is going to be a mix of Murban and heavy crude, maybe. So I think this thing turns around rather quickly. And then on the LATAM side, there was fallout on the Canadian diffs, there was fallout on the Gulf Coast sour market. I suspect that will also correct because it seems like Venezuelan crude is going to be marketed all over the place. And it's not my super area of expertise, but I'm under the impression that, over the last 10 years, US refineries really tried to invest in refining light crude. And it's probable that there's not the same level of homes for Venezuelan barrels as there were way back when those barrels were legitimate. So I think it'll be marketed more to Asia than perhaps the market appreciates at the moment.
I guess it probably all boils down to price in the end, right? If it arrives at the right price, refiners will find a way to get it into the system again. But at least on that, I saw a headline this morning about Venezuelan barrels being marketed still at a premium to the Canadian barrels, for example, on the Gulf Coast.
In the Gulf Coast, interesting, yeah, because I saw a headline of like -8 delivered to India, which looks to be cheaper than what you could maybe get WCS to India for, maybe a bit cheaper than TMX in the Far East. So, yeah, maybe that's it goes in the same direction. It looks maybe a bit too expensive in the Gulf Coast, but being marketed well in the East. That makes sense to me.
I did have one question, if I may, on
Go on.
What you were saying before about obviously TI Brent widening and TI not looking fantastic into the east, whilst we've got a strong dated complex. I guess that just means that there's a lot more TI interest into Northwest Europe. TD25 feel from here. I don't know what that's done recently, but I guess that are
strong.
Probably now. Yeah. Okay. So more TI into Europe versus heading east.
Yes, that's what the relative ARB econs tell us. It looks slightly better now in the Far East just today as we speak, because there has been a big move on freight, particularly TD3C, and the Murban FOB premiums have come up. So WTI doesn't look as poor as it did a few days ago in Asia, but yet it still looks very cheap in Europe. And I think as a first case, you end up with some kind of CIF TI market being bid up in Northwest Europe, but then it can collapse the whole complex eventually. I think it makes sense that the Brent market gets basically flooded with the return of lots of barrels. It's just a question of timing. I've talked about this many times in the past. I never get the timing right, but it makes sense directionally, let's say.
Yeah, fair.
All right, guys, let's wrap up. That was a 40-minute episode so far. What do we think about a couple of trade ideas? I'm going to start with you, Jorge.
Yeah, I think I have one more clear. It would be at these levels, short Q2 east-west. We are above 30, 31. I think we are close to 32. So for the whole Q2. So I think, yeah, that could be an idea. And then more risky, I kind of feel like I'm bullish for gas nafta, also Q2 for the for summer for the rolling after the rolling, but the market is already strong in some way. We are above 150. We have seen levels close to 300 during the last years, but I feel we've seen that story for 3 years in a row, maybe. Like Gasnap was already strong before summer, like one quarter before summer or 2 quarters, but then it rallied a lot. So I will think more about this trade idea, but I kind of want to propose it. Yeah.
I like it. When you said that you're feeling a bit bullish, Gasnap Q2, and I thought it's at 150, I thought, are you sure? But actually, you're right. You're right. The last couple of years, we're in a position where that can very much go higher.
Yep. Yeah.
Okay, sounds good. Phil, you're in agreement. No, you don't get off. You don't get let off that easily.
Okay. In that case, I'll switch over to the diesel market and suggest that actually, you know what, you've convinced me, Neil. I think yes. There is some. I think from here, as I said, March is trading at +3-ish today. I think it's fair to say if we get, it just needs one or two headlines. It just needs kind of a bit of an agreement that certain, that the next refinery maintenance cycle is going to be a bit heavier, or a continued cold weather snap, and there's plenty of risk to the upside here. I think so. So yeah, on balance of risk, you'd be long gas oil spreads here.
Risk reward. Okay, sounds good. And I'm going to go for the only thing I can really do just now, which is that the classic spreads tend to mean revert. So short Brent spreads, short EFS, long TI versus Brent. And that feels like the only thing I can possibly do, because that's fundamentally what needs to happen unless Iranian supply gets absolutely, crushed. Unless something major happens in the Middle East, I think it's just mean reversion, basically. All righty, no arguments against that one, I see. So we'll take it as gospel. And that's a wrap from us here at Sparta. Thanks very much for listening to the latest episode. I think we're going to get Felipe on as host next week, so you get a break from my droning voice. Yeah, thanks very much for listening. We wish you a happy week of trading with conviction. Until next time. And thanks very much, Phil and Jorge.
Thank you.
Thank you.
Bye-bye.